Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online shared trading division. In this educational series, we will discuss various topics related to economic indicators. Learning about the different economic indicators is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there is more to this than meets the eye. In this video, we will cover the most useful economic indicators. We will identify different types of economic indicators, establish what economic indicators are, and why they are important. In part 2 of this topic, we will discuss other important macroeconomic indicators. Please note that this session is on both a beginner and intermediate level. Please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice and is only for educational purposes. Let us start this session. First, we must establish what is an economic indicator. Economic indicators give traders and investors pivotal insights into the well-being of a country's economy, which can impact the profitability of positions on a range of markets, including forex, equities, and indices. Economic indicators are referred to as macroeconomic indicators, as they show economic data on a large scale. Macroeconomic indicators analyze current and future trends. Macroeconomic indicators are also used for investment purposes or to judge the well-being of a country's economy. Economic indicators are usually official data released and produced by governments or non-profit organizations. The next topic that we will discuss is the purpose of economic indicators. The main purpose of economic indicators is to give investors, traders, and analysts an understanding of the state of an economy. It provides statistics that can help them locate new opportunities and adjust their portfolios. Economic indicator announcements are widely followed, which means markets can progress dramatically around each release as traders and investors adjust their positions. Therefore, most fundamental analysis will include economic indicators. Traders and investors will keep an eye on analysts' predictions for upcoming data releases to shape their trading strategies. If the actual figures are massively different from the expectations, there can be more volatility as everyone scrambles to adjust. As most economic indicators are produced by or for policymakers, these indicators can also influence decisions going forward and ultimately change the course of political strategies. Economic indicators will have a larger influence in the countries that have large economic shifts. Economic indicators are divided into 3 wider groups. The first group will be leading indicators and are used to predict future movements and trends of the economy. These figures change before the economy does, which can be helpful for identifying opportunities, but risky as they're not 100% accurate. The second group, coincident indicators, are the result of specific economic activities. These indicators are useful metrics only for one particular area or region, but are real-time snapshots of the economy. Lastly is lagging indicators, which trail the economy and are released after economic activity occurs. These aren't necessarily useful for identifying trading opportunities, but provide essential insights into the health of an economy. There are a couple of useful economic indicators to keep an eye on. The macroeconomic indicators we are discussing in this part are gross domestic product or GDP, interest rate, currency markets, equity markets, and lastly, unemployment and wages. Let's discuss gross domestic product or GDP. Gross domestic product is the market value of all goods and services produced within a country during a given time period. GDP is a lagging indicator, but it's also one of the most popular gauges of economic well-being. There are usually 2 GDP figures given in a release, nominal and real formats. Nominal GDP is the standard value which evaluates the value of goods and services at the current market price. Real GDP is the final value adjusted for price changes that occur over time. The GDP is closely watched by financial markets, as an increase or decrease in GDP will show how much money businesses have been making during the period. GDP is considered a good economic indicator as it accurately measures the size of the economy. However, GDP is a lagging indicator, which means there is only so much it can reveal about the outlook for an economy. It can be used to determine an appropriate level of sovereign debt for a country. GDP determines if companies operating within the country are likely to experience growth. The second important economic indicator is that of interest rates, which are the percentage charged on loans or paid to the owners of savings accounts. The interest rate is set by a country's central bank and then trickles down to the commercial banks and consumers. Interest rates are increased to curb inflation and lowered to promote growth. Interest rates are one of the most influential factors for currency markets due to the impact they can have on the value of currencies. Higher interest rates indicate a strong economy, which makes investors more likely to buy the currency, which leads to rising values. The rising interest rates can also mean a higher rate of return for savings and bank accounts, which could encourage people to save instead of buying higher risk investments. The reverse would be true if interest rates fell. The national currency would devalue, and the low interest on savings accounts would make higher risk investments more worthwhile. Interest rates are useful as both a leading and lagging economic indicator. As changes to interest rates take into account a past period of economic activity, they are a lagging indicator for that period. However, once the decision to change an interest rate has been made, this will be a leading indicator for the next period of economic activity. The next economic indicator is the currency strength. National currencies are used as a benchmark of the country's economy, as their value is a reflection of how much buyers and sellers think it's worth. A strong economy will encourage investments, and buyers will become willing to pay more for the currency. This provides a boost to the economy. When a country has a strong currency, its purchasing power rises to enable them to import products at a discounted rate and sell products internationally at higher rates. A weak economy discourages investment, which causes the value of a currency to decline. This reduces purchasing power, making it more expensive to import goods and making it cheaper for other countries to buy products. A weak economy can also boost tourism. Currency strength is an extremely popular economic indicator. This is a lagging indicator as it's a product of events that have already happened. Economic indicator 4 on the list is the equity market. The equity market is a public venue where individuals and institutions come together to buy and sell the shares of companies and exchange traded funds or ETFs. It is part of an investor's analysis methodology to look at a company's historic earnings and future earnings outlook. It is often thought that the direction of the equity market can be used to predict which direction the economy could go. The equity market isn't necessarily a good leading economic indicator because earnings estimates aren't the only factor considered in equity prices. There is also a heavy amount of speculation on the equity market, which can manipulate prices to seem better or worse than they actually are. Governments have also been known to play a hand in stabilizing equity markets in order to avoid panic during crisis. If company revenues are down across the board and the equity market is declining, then this will affect the country's GDP and add to a slowing economy, and vice versa. The last economic indicator for this first part series is unemployment and wages. Unemployment data and wages are statistics that look at the number of jobs in an economy and how much each individual is being paid for their work. The unemployment date is usually released a few times a year and is used to assess the levels of inactivity in the workforce. High rates of inactivity, coupled with lower wages, is indicative of a period of recession, while low employment statistics with increasing wages shows the economy is growing. Unemployment figures are closely watched by traders and investors all over the world as periods of high unemployment are associated with declining equity prices. Unemployment data is usually collected by wide-scale surveys, which means it's highly representative of the economy over a given period. However, the survey is just a snapshot in time, which means by the time the data is released, the statistics could be outdated. As a lagging indicator, unemployment data should be used as just one part of your analysis. This concludes this session. In part 2 of this topic, we will discuss other important macroeconomic indicators. This educational session was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.